So last week, Jamie Dimon sounded the alarm on private credit, pointing out that the loans have not yet faced a real economic downturn. This article says, sounds like junk bonds circa 1990. Folks who were around then understand just how dire that particular warning is. Here's the thing, though. It's not the first time that we've seen such a warning. This is an article from Institutional Investor. I want to point out something here. It's from January 2020. High yield was Oxy. Private credit is fentanyl. Yet investors are hooked and it won't end well. I mean, think about that. That's 4 years ago. Well, investors are hooked. And, well, so far it hasn't ended well, except unless, you're on the private equity side, private capital side. This is the last 6 years. 1.5, almost $1.6 trillion more has been held than has been distributed to these investors. So I want to break down the risk here because more and more investors are being offered these products. Bring in Jim Bianco, research president. Jim, I know some viewers are unfamiliar, but the private capital world is opening up more and more to individual investors. And I just got to talk to you about these products. Explain a little bit what they are, and let's talk about these risks.
So private credit is what the words imply, is that you get a loan from a company that is not a bank. And because it's not a bank, it has much less regulations and it has much of a freer hand to structure the loan the way you want. They raise money from investors to hand out these loans. Now, they directly compete with the banks, and the banks don't like it because they're under a burdensome number of regulations and regulatory agencies, where the private credit industry is not. And the concern that you were pointing out is this is fairly new. These loans are being handed out. They're a bit opaque, and we don't know what's going to be the disposition of these loans on the next downturn. If they go bad, are investors going to lose money? Who are the investors? Do they really understand the risks?
Yeah, it's I think it is going to be pretty ugly. And to your point, that we just don't know to what degree. I want to talk about the markets here a moment. You posted a chart of the 4 largest stocks. All right, we talked Mag 7, Mag 5, the 4 largest in the S&P 500. And again, the point here, underscoring, you got to go way back, folks. This is 1965. For anything sort of similar to this, when you see this kind of concentration, does it mask risk or does it mask opportunity? What does it say to you?
Oh, I think it masks risks. You're right. The Fabulous Four, which is NVIDIA, Meta, Amazon, and Google, are accounting for over half the gain in the stock market. Well, people say, well, that's why you want to invest in an index because you never know what's going to be the next upturn. Yeah, well, the Fabulous Four could also drag the index underwater. And any one of the other 496 companies, if you threw a dart at the board, would probably beat it somewhere in the future. So, yeah, you're basically buying an index fund because you think you're getting diversification, but you're not getting diversification. You're being dominated by 4 stocks that are very similar to each other. I might add that NVIDIA's top 3 customers are the other 3 companies, that it's about a third of its revenues. So they're all intertwined with each other. And so you're losing that diversification you think you get by buying an index.
I got to ask you about the 10-year yield. It's been coming down. It felt like that 470 obviously was a really spooky point. Under 450 was supposed to kind of move this market. Just so the audience understands, here recently, there's been this inverse relationship. So yields go down, market goes up. Yield goes up, market goes down. So the yield, we've been under this 4.5 point here for a little bit for a couple of days. The market has looked a little weak, although I pointed out at the top of the show, we've had these intraday reversals Friday, Monday, and we're getting a big one right now. So maybe right on cue.
Yeah, you got to keep in mind that the way I think the stock market views interest rates is competition. When interest rates go up, people look around and say, well, I could get 5% in a 2-year note, or I can the Fed's not going to cut, and I could get 5.40 in a money market fund. That's good enough. I'll take that and not invest in stocks. But when yields go down, then we could start screaming Tina. There is no alternative. You have to get out of the bond market. You have to get into stocks. So if you think of it as competition, this relationship somewhat makes sense, as opposed to what do interest rates mean for the economy. The stock market's not worried about that right now. It's more worried about interest rates being competition.
Real quick before I let you go, buybacks now at a record level here. These are your last. These are all the month of May's. You've got two schools of thought. On one hand, between the buybacks and then all of the way stock is used as incentive for management and companies, we got this big stock split coming on Friday with NVIDIA. The role of buybacks, are they as legitimate as they once were, or is it some form of manipulation?
I wouldn't go as far as to say manipulation, but buybacks do tell us one important thing in this environment. Virtually all the money that you use to buy back your stock is you borrow it. You issue a bond, and then you use that bond to buy back your stock. So what are companies telling us? They're telling us that interest rates are not that onerous. They're not that restrictive because they're happy to issue bonds at current levels of interest rates and use that to buy back their stock because they think that their stock will be a better performer than that bond that they've issued. So there is a signaling in there that the interest rate market is not hurting the economy as much as people think it is. And it gets back to our previous conversation about the 4.5% in the stock market. It views it as competition. It doesn't view it as a restrictiveness for the economy.
All right, great stuff. Hey, Jim, thank you a lot. We really went through some really important issues here. Thanks, my man.
Thank you.
All right, folks, reports of the death of the